Let's get in a global voice to speak about India, possibly the entire emerging market pack. But start off with asking Masha Gordon about what's happening on India. She's a VP and head of emerging market equities at PIMCO, who joins us on the show. Masha, good having you. Thanks much for joining in. Just looking at our markets today, can't help but asking you about your stance because you've been underweight on India for a while now. Has the position changed post the recent correction? Does India offer value now?
We have been increasing some of our positions, particularly in private banks, during recent correction. We still remain underweight India. As we go into the election year, we think politics will remain, a political balance will remain quite fragile, and therefore we will need to pick our spots in terms of finding value to have a further conviction, a further exposure to the market.
Masha, hi, morning. The last time we spoke, you had indicated that the reform push by the Indian government was encouraging. What's your view now?
Well, look, clearly some of the laws that have been passed will prove to be beneficial if they indeed implemented, and that's the Foreign Direct Investment Acts that endorse investment in retail and other areas of the economy. But clearly what we need to see is the cohesion between the federal and the state levels and determination to conduct the structural reform that reduces fiscal deficits. And that's where I think we need greater political unity and perhaps less pressure from the electoral cycle to see that getting realized.
Masha, what about the political risk for India over the next 2 years? What are your channel checks suggesting or indicating about, whether the political situation would remain stable or would it be a bumpy ride?
Well, it's not my channel checks, it's the news flow every day, right? And the what we've seen, recently with two parties either threatening or pulling out of coalition, that underscores the fragility. So I think that should we have a speedy election called in the fall, that potentially may be a positive for the markets if there is a decisive majority elected, or if anything that will cut in half that limbo time and electioneering time that tends to be very detrimental for confidence in the markets.
So how do you see the macro risks in growth and inflation for India? Can we see a growth of 6% plus next year as per your targets?
Well, 6% growth relies on a number of assumptions, one being that the interest rate environment remains supportive, and that is clearly hinging on the inflation not seeing a shock. That is a question of the rupee stability. That is a question of the oil price stability. And then, we clearly need to see the pick up in investment activity to support growth beyond that. So, yes, we're working with 6%, but the political uncertainty, any spike in oil price would bring that number into question.
Masha, India within emerging markets has been one of the weaker hands, at least of late. Is it due to unwinding of 2012 gains, or are funds turning bearish on India?
There has been, and I would say, a very strong enthusiasm last year that met the appointment of the finance minister. And the enthusiasm that endorsed the reforms, and I think the tone with which these reforms have been communicated. Clearly some of that has been unwound in a way of a bit of a hangover. And coming into this year, we have more question marks posed by reality of coalition politics. So I would say it's a mid-cycle correction from perhaps elevated levels, but we still remain positive on a number of corporates in India. Namely, private banks should continue doing well. The stronger are getting stronger. And if you look at even such well-established franchises as, let's say, HDFC Mortgage Bank, there were plenty of doubters around whether this bank can grow and can maintain its market share. What the bank has shown is that not only it can maintain, it can increase the market share and print loan growth at 30% per annum. So there are corporates that have done well, that have the footprint, that have the organizational backbone behind them, and that should continue printing confident earnings story with them.
Right. So what do you see as the biggest risk for India and the impact of that on the markets?
Clearly, fragility of politics and pre-election fiscal incontinence. If a big thing that the current finance minister made was the fiscal consolidation, reduction in expenditures, and as we go into the election year and year, any giveaways, any large printing of money, any removal, any reintroduction of the subsidies that have been removed previously will be taken very, very negatively. So we need to see steps forward, not steps back from the tentative steps towards success that the government has made in the past few months.
What did you make of the recent noises accusing the private banks of money laundering?
Well, look, first of all, no specific allegations have been made. They were quite generic. It is very good that the banks have stepped up and have endorsed investigation by the government, has volunteered cooperation, and more than anything have established their own audit committees to go through practices. In reality, what that might mean for the banks is fines, which again in the scope of their profit pools are not particularly significant. It will reinforce the governance, which is, as investors, something we embrace, and it might, on the downside, slow down license extension for the branches. Again, for some banks, it's more significant. For the banks that we hold, it's perhaps less relevant.
Masha, you were disappointed with the Jain irrigation story. Analysts believe it could be turning around. Are you optimistic, though?
For me, it's a great example of where the politics and the business come together. The thrust of the story was that this should have been a poster child of corporates benefiting from India's secular growth. It's an irrigation company with the products that all the farmers should want, with the state that has the programs. But if you remember and recall, the states were effectively not willing to extend real money, and the company ended up in a liquidity crunch. And again, the test will come to bear when we will see whether the corporate actions will indeed result in more cash. The business had to shrink. That's the bottom line, and that's the set punchline for a corporate that should have been thriving. It had to shrink to continue existence. So yes, we have seen some tentative signs that select states have been coming good on their obligations. But again, for this company to grow significantly, you need to see their new non-bank financial subsidiary working well, the farmers accepting the new regime, and this whole story of subsidies coming true.
Aside of banks, energy has been the big theme in India. RIL, ONGC are being touted as stories that would turn around soon. Is your conviction building there?
We don't own these names, and I tell you why. I mean, the market is excited about removal of subsidy to the market, and the market is extrapolating that this will be corporates that will benefit. Our view is that the key beneficiary will be the state. The state, first and foremost, has to cut that part of the subsidy from its budget deficit, and over time we would hope that the regime, because indeed free market, and these companies can benefit from getting market prices for their goods. But again, as it stands today, it's not clear to me that the corporate will be an immediate beneficiary of the subsidy removal.
Right, so has your portfolio strategy changed over the last 3 months then? What is it that you've offloaded or added in your India exposure portfolio?
Sure. Well, we are long-term investors. Our turnover is not significant. We're not day traders. So over the past 3 months, we've added to our position in the banks. Namely, we've added to Axis Bank. We think that there are some positive developments on the side of non-performing loans, with Indian growth picking up gradually from the levels in the past 18 months. We should see the loan quality improving, and we should see the gradual build-out of the retail franchise that should help with funding costs, to access that lag the private banks in the development of the funding franchise. So we're excited about that story, and this is the more recent addition to our portfolio.
Masha, developed markets in Japan have been outperformers this year versus the emerging markets. Do you expect that to continue in the rest of 2013 as well?
Emerging markets are undergoing a mid-cycle correction. These are the economies that have grown very strongly up until 2008. These are economies that have built up quite a bit of operating leverage. So when we're experiencing the bout of a very slow growth globally, EMs suffer from negative operating leverage. So what we have seen in the corporate sector is a decline in margins and decline in profitability, and what we need badly is a pickup in economic growth to jumpstart the earnings. Contrary to that, the U.S. market has been in a difficult amidst the difficult correction, not prices wise, but fundamental wise, right? The housing market has been in the midst of 6-year correction until a year ago. So clearly there are very powerful factors that could continue supporting earnings, and if anything could continue supporting confidence that the consumer, which is a very large part of the economy, does well. Japan, as you know, has been in doldrums for 20 years. Companies look inexpensive, but clearly need a support of a weaker currency. So again, a very big policy story. So near term, it looks like DM and Japan do have a stronger underpin of the macro tailwinds, whilst EM will continue muddling through. But again, companies are getting cheaper, and should Japan and U.S. growth result in a jolt of the global growth, we could see EMs performing better for the remainder of the year.
Masha, really good chatting with you. Appreciate you taking the time out and joining us today on ET Now.